Good afternoon. Stuart kindly introduced me, but just for the avoidance of doubt, whilst I do know quite a few of the people in the room already and had an opportunity to meet, my name is Swansbury, Director of Corporate Finance at a mid-tier advisory firm called Ryecroft Glenton. As Stuart said, we've worked within the staffing human capital sector now for many years, and specifically I've focused on the sector for the last 7 years, working with entrepreneurs, shareholders, on all aspects of business planning, all the way from start a business, so creating a business plan, documenting a business plan, making sure it's a fundable plan, because a plan without funding is worthless, and working with the entrepreneur, the management team, all the way from starting their business venture, all the way through to helping them achieve their objectives. That might be a capital event, it might be a lifestyle business, it actually might be they just want to create a brand that they are proud of, and I respect each of those. And my job as a corporate financier is to understand the inside-out psychology of every single shareholder in a business and to work with them relentlessly to deliver whatever it is that they want to deliver for themselves. I think there's two things I mentioned before we talk about content, and I share with you an insight into what we're covering, what is only a 25-minute slot. I think the first thing to mention is that as a corporate financier, not only is the word corporate finance often a bit of a mystique, because I'm not sure many people know what a corporate financier does, so let me just explain. For me, I am a qualified chartered accountant, but what I am is a business advisor, and I work with people throughout their entire business life cycle. So from startup all the way through to extracting a capital sum. I think the second thing just to mention is that, without question, the word exceptional is very, very biased, and I guess everyone in this room will have their own view over what an exceptional staffing business will be. So what I thought we would do is just understand what the purchaser of a staffing business sees as exceptional. Beauty is in the eye of the beholder, I appreciate, and therefore you might think, well, the purchaser might like a business that looks that way, but that's not my business. Again, please let me apologise if I'm almost being rude in regard to your own business, but what I can share with you is what the purchaser sees as exceptional, which is a good starting point. I think rather than have questions at the end, guys, please feel free to stop me and challenge me and question me as we go, rather than have questions at the end. Of course, we can reserve those questions if you like. I think we've covered a lot of the introduction, so don't need to go through that. Apologies for the horrific picture. We thought we'd try and be slightly American. In terms of the business, the majority of businesses I work with are trying to achieve capital worth. Because whilst we all love what we do, and the staffing sector is a fantastic one, often there is a capital extraction at the forefront of everybody's mind. So what I thought I would do is just share with you very briefly an insight into how a business will be valued. I'd say 99% of the transactions in our sector are valued in this way, and we can then pick out each component part and understand how you can focus on improving each aspect of your business to improve its value, therefore making it more exceptional. So in short, a business is valued by obtaining a maintainable earnings number, which is profit. It needs to be sustainable profit. But once you have established in your business a profit number which the business will continually deliver, you then multiply that by a price earnings multiple. Appreciate small SME businesses don't have PE multiple, because of course only a listed business would have that. But what one can do is look at the sector, look at fully listed, AIM-listed staffing businesses, and work out an average price earnings multiple. Again, depending on which aspect and sector of human capital would dictate that multiple, but it's a good starting point. And Will and I were just chatting over coffee, and Will's been looking at the PE multiple of listed businesses, what their GP delivery has been, because I guess if you can compare yourself to a peer, that's a good starting point. So that is the calculation that the majority of purchasers, whether it's trades, whether it's a management buyout team, or whether it in fact is a venture capital private equity house, that is the calculation they will perform when valuing your business. Too much detail there, I'm not sure it's important to talk through, but that is a calculation of maintainable earnings. So you might think, that's my operating profit, times that by 5, £1 million, my business is worth £1 million. I disagree, because ultimately, have you extracted the emolument from your business? You might choose to take your salary of £7,000 because it's tax efficient, but you'll sort of take well through dividend. If that's the case, of course, you've got to deduct a reasonable market rate for you yourselves. Likewise, things like lifestyle costs. You might take a number of lifestyle opportunities from your business which are tax efficient, but of course those costs might not be incurred post an event, so we have to factor that back in to come to a profit number. Once you have that profit number, You can then times that by your price multiple. This was some research we did 28th of May, and that was an average of 5 staffing businesses, and that was their multiple, which averaged at 7. If you discount that, because of course a private company has no liquidity, unlike an AIM-listed or fully listed business, so if you discount that, say by 30%, again judgment, but 30% again is quite typical, that will take you to a multiple of 5. So in that instance, you times your weighted average profits of 4 million by 5, and that will give you an enterprise value. The only thing I'm going to leave on this slide is debt. To get from enterprise value to equity value, you have to adjust for debt or surplus cash. What does that mean? It means if you have a business that has a balance sheet which has £1 million of term loan, a purchaser will say, Mr. Vendor, Miss Vendor, that is your debt, and therefore that will be deducted from the price we will pay for your business. The interesting debate right now in every single corporate financier's offices is invoice discounting debt or a revolving working capital facility. Only this morning I had a debate, and it was definitely a debate, with the vendor of a business. They are adamant their facility is revolving working capital, and of course my acquirer has the opposite view, which is it is debt and it will come off the purchase price. And I would say seek advice, because that can have a substantial impact, and I mean 7-figure impact on the sum you extract. Okay, so that's just the theory as to how you value a business. That's all great. The science means nothing to anyone really. So what I thought we would do now is share with you, from our substantial experience, how you can improve the equity value of your business, and therefore how can you improve how exceptional it is. And these aren't textbook answers, these aren't at all a list of theories, these are from our recent experience of concluding transactions in the sector, which we'll share with you. This is how the owners of a staffing business has improved its worth, full stop. So these things ultimately can help you increase your multiple from 3-4 to 6-7. So these things are true things that will improve your business's attractiveness. So I think the first is you have to be able to generate, and more importantly prove, that your business can generate sustainable revenues and margins. What that means is if a purchaser is acquiring your business and paying 5 times for it, they expect at least in the next 5 years for your business to deliver that level of profitability. So my advice is that you do need to make sure your business growth is intentional, is smoothed, and is not erratic. And I think that a lot of staffing businesses I see, certainly small sort of SME businesses, they have a fantastic 1 year, a terrible next, a fantastic next, and that actually gives no one any confidence, because all you've got there is an opportunistic business, and why would an acquirer want to buy that type of business? The next point, which I'm sure a lot of the speakers that I spoke already would agree, certainly Denise, it's important that you have good quality, reliable, accurate financial data. I'm sure we'll all say, yes, but Carl, we have Sage printouts. Not adequate at all. I think right now, whilst it's impossible to forecast for the next 12 months, I appreciate, I guess only you can forecast. The purchaser can't forecast your business because they don't know it. So to have accurate, timely management information is essential. Having forecasts that are achievable, realistic, is essential. And for me, that is where I think a lot of staffing businesses fall down. A lot of staffing businesses have fantastic sales directors and are very focused in delivering new turnover, but do they maintain accounting records that show that growth in the right way? Question. Third point, initiatives to lock in key members of the management team. We're currently in the process of acquiring an IT staffing business on behalf of the purchaser. And the target business, one shareholder, told us at the first meeting that his management team is the most important thing in his business. He has substantial respect for them, and he wants to make sure that the purchaser who buys the business will look after them. I said, fantastic, can you just talk me through how you have tied in this fantastic asset of yours? He said, well, Carl, of course, they've got restrictive covenants, and of course, they've got to give 1 month's notice. Sorry, I'm still none the wiser. How do you make sure that when your business is purchased, that the key asset that you've just highlighted as a key asset doesn't go with it, i.e. doesn't leave the business with you? And the way you can do that is things like option agreements, so maybe an approved EMI share option scheme, which gives you the chance to give your staff equity opportunity on delivering a certain milestone. Is it turnover growth? Is it change in ownership? Is it a sale event? It could be any of those things or all of them. The point is, you are demonstrating with equity that what you say, in fact, you believe, which again, if you can do that, that will give the purchaser not only a real management team that they will inherit, but will give you a fantastic opportunity to take out from your business what is hopefully a fantastic 7-8 figure sum on sale of it. Fourth point pretty much links to the third, in that if you do that, you are distancing yourself from the business. So I guarantee the majority of you guys who are at the core fish of your business will still speak to every single one of your clients. You will be the business. The value of the business rests in you. I think you can work out the rest for yourself, but for sure, if that's the case, and you do intend in the next 2, 5, 10, 15 years to sell your business, you need to become an ambassador rather than a driver and a deliverer of business. I think linking to point 3, if you give your management team equity incentive, maybe that achieves it. You do need to demonstrate impressive growth, but as well as opportunities to grow further. I think a business that's saturated, a business that's done all it can do, is not attractive. It might be attractive as a cash cow, going back to your presentation of earlier, but actually if there is no more growth opportunity left, all you can do is sweat that asset. And in this market, that's not of interest to any of my acquirers, for sure. Next point down, you do need to have a well-regarded brand. This is an interesting point because I guess we will all agree in the human capital space that brand is important. But I would ask how many of us go out of our way daily to make sure our brand is positioned correctly. And I think not just sort of giving a business card and saying, you know, we are experts in our field. I mean actually having intentional advertorial in the press, making sure every single day there is a news article released. Of course, it has to be worthy news, but you guys will be doing fantastic things in your business, whether it's a new account, new member of staff, new office opening. Why not just share that? And you know, our firm in the last year, we started to proactively do that, because doing what you do well without telling people, I'm not sure is enough now. You know, we have to just share good news, because I think it's self-fulfilling. So you do need to develop a well-regarded brand. You need to be known not only by your customers, well, if you weren't, I guess you wouldn't have a business, but as well as being known by your customers, you do need to be known by your peers and your prospective purchasers. The majority of lucrative transactions that we see are transactions where the purchaser has approached you because you are attractive, you are a thorn in their side, you are causing an aggravation when you pitch for a PSL or a sole supplier agreement. You need to cause your potential purchaser trouble. And that goes back to beauty being in the eye of the beholder. Every single management board I work with, I sit down and say, right, why are you doing what you're doing? You certainly aren't doing it because you've got no hobbies, and you certainly aren't doing it because you've got nothing else better to do. What is your intention? And often it's a capital event. If so, let's try and use hindsight. Let's work out who your purchaser is today, and let's understand what they will expect your business to look like. If you can then create that business, that's just market research. Without question, the transaction will just conclude. Most business owners, however, aimlessly build, deliver a fantastic business, and then look outside of it. Is there a home for it? And sometimes there is, but you have to be flexible at that point. So I think market research before you build a business is so important. Bearing in mind you wouldn't have set it up without knowing there's a market there for it. Moving further down, build strong contractual relationships. This has proven really important in the last sort of 3-4 months on all of the boards I work with. This is something we've proactively did for 2 reasons. I think, you know, we all have great relationships with our clients. Often that will be a handshake type arrangement, given that I appreciate sole supply, unless you're a large business, is non-existent. But I think even having documented preferred supplier agreement, where there is no change of ownership provision included, being a key point, that will add value, and that will make your business more attractive, because you assume there is more sustainability in a business that has contracts, that has guaranteed, or at least guaranteed commitment to do business as and when there is an opportunity to recruit. I appreciate no sole supply means guaranteed revenue. So please, if there's one thing I could ask you to do, you know, please go away and just think, right, these are my top 10 clients, these are my key clients. Without these, our business wouldn't work. Make sure that without question, that commitment that they gave you is documented. You know, is it worth something? Question mark. But without question, it's not difficult to do, so I'd suggest you do that as a priority. Last point, in terms of how can your business achieve more worth on a transaction, I think we touched on earlier entrepreneurs relief. You'll appreciate that on sale of shares in a business, as long as you achieve certain criteria, you do obtain the benefit of entrepreneurs relief, which means capital gains tax will be charged at 10% versus 28%. And in terms of criteria, you do need to own 5% of the shares or more for 12 months prior to an event, and you have to be an employee in the business. That becomes interesting when you have self-employed employees, i.e. a business I'm advising now has a sales director who is self-employed. Interesting debate. So at the moment there's a lot of businesses suggesting your employees should become self-employed individuals. Forget about badges of trade. I think there is an issue, because will that person be entitled to entrepreneur's relief? Then the answer is no. Slide. Okay, so I think in terms of deals done, so I'm trying to take us back to what makes an exceptional staffing business, because whilst we've talked a lot through operational changes that one can make today, I think the overriding subject that we're covering is how will your business become exceptional? So I think in here, hopefully, I can tell you what I've learned from advising owner managers on the sale of their business and how we made their business exceptional before and then. I think the second point, adversity, it does create opportunities. So, whilst I read the press and I appreciate what the European Union looks like and the Eurozone, whilst I understand the double-dip recession, I don't buy it, i.e., businesses are still exceptional. Management teams will still work hard to build an excellent business. With that comes opportunity. So whilst I absolutely have to appreciate that, for instance, Stuart and his credit team might take a certain view, you still absolutely want to find the right business. And Stuart and I work on a number of transactions together, and ultimately, as long as your business is exceptional, without question, it will be attractive too. And of course, we'll receive support from the likes of Lloyds and Stuart. In terms of accurate information, I think I mentioned that earlier. It is important that you do have a fully documented suite of management information, and that is not a P&L account, that is a balance sheet, that is a cash flow forecast, because if you have volatility in your profit and loss account, which I'm sure you all do, if I said to you, in the next 12 months, how will you fund your volatile profit and loss account? Often, you just get a blank look, and people are almost just seeing how it goes, and I'm not sure whether a buyer of a staffing business would accept that. I certainly wouldn't. I think we're finding that financial due diligence is becoming more important, and legal due diligence. So I think what makes a business exceptional is if the business's foundations are solid. So rather than focusing on turnover growth, chasing margin, maybe we should stop and think, do we have the right shareholders agreement in place? So if you've got two shareholders, a 90%, 10% shareholder, if the 10% shareholder had a different objective to the 90% shareholder, how would that work out if you were approached by a purchaser? You need a shareholders agreement. Do your articles of association mirror that shareholders agreement? Do you have employment contracts that are robust? Again, from my experience, often not. It'll be a contract of employment that's been rolled forward for the last 35 years and is not up to date, is not relevant, and doesn't have any reference to restrictive covenants or restrictive covenants that could potentially be followed through in the court of law. Next point, timing. I guess to make an exceptional staffing business, you do have to almost sit down and think, in the next 2 years, what will the market look like? I think we've got a good view, it's going to be challenging. How do you then take advantage of that challenging market? So for instance, one of my large clients, who we will, in the next 4 or 5 years, see a change in ownership within, I sit on their board, and quarterly we meet, and we are currently going through a strategic review of their business. And one of the things that the managing director of this £22 million turnover IT telco staffing business is concerned about is that their IT search and selection business is falling off a cliff, using her words. So within 15 minutes, and it wasn't even as long as that, we assessed how can the business utilise already what it has, which is awesome relationships with some brilliant blue chip financial institutions. How can we use that to make sure the business is defendable? The answer is change management. So we now have the business, we have a brand which is change management, we've gone to each of their key clients, which is only 7 in length, and we now have PSL with 3, and we are pitching for the other 4 to provide change management staff. So not IT staff, but change management. Every single financial institution is changing, and that's a great market from a contract perspective. So you will have great opportunity that maybe might not be obvious, because I guess we all know what we know. Patience and resilience, I think those 2 things make the business exceptional, because I think not so exceptional businesses right now are reacting. So it's easy to react, the treadmill gets faster, we get slower, and you're none the wiser for it, especially when you're trying to chase margin alongside these large nationals. So patience is key, and I think one of the questions that was asked by the gent earlier was about, what do we do if, we are seeing some of our key accounts slow down their recruitment or try and recruit themselves, because of course they can do that, because it's only recruitment, isn't it? Actually, patience is key. Let them try. We know what we do And we know our sector, they don't. They run banks for a reason, and they don't run staffing businesses. So patience will come good, and certainly in what I do, we have to be very, very patient, and sometimes that's not to my benefit. And I think one thing Stuart said about me is important. I'm not a typical corporate financier in that it's not about the transaction. For me, it's about working with entrepreneurs, helping them deliver what they want to deliver. In turn, I will benefit, of course. We all are here for a reason, but my objective is not important. My clients is. In turn, it works. Yes, point 7, staffing businesses with a bias toward a contractor. So one of the questions that the gent asked earlier, which was where our acquirers are coming from, vertical, horizontal integration. In short, both is the answer. Contract and temporary businesses are more exceptional because they are more recurring in nature. Search and selection is very profitable, but of course it's challenging because without the same team, the P&L would stop. So I think if you want to create a more attractive business, having a contract piece attaching to a search and selection piece, for me, is logical. And actually, it means you can be holistic in your offering, can't you? So rather than just speaking to the MD of Goldman Sachs about their search and selection senior appointments, maybe also they do have a contracting need. It would almost be ludicrous not to try and make sure you are their exclusive HR advisor. Excuse me. I think management teams, an exceptional business has to have a good team, certainly in the human capital sector. Without that, what do we have? So I think I would ask you to go back and really assess, what does your business look like below you? How much does the business rely on you? If you removed your card from that stack, would it fall down? If the answer is yes, then actually your business will not be that attractive right now, so maybe you have to go out of your way to try and create a more robust or experienced management team. And that sounds obvious, but you'll be surprised how many of my substantial clients have a managing director and then just the business. And he's chasing every single branch manager each day. That's not a business. It's just 7 different businesses collude under one brand. And again, that'll have an impact on the obvious, value. I think what makes a business attractive is its focus. Again, I think one of your key points this morning was 7 key priorities, and Stuart and I were laughing because you're absolutely right. Focus and diligence right now is so important. It's so easy to lose focus when the world is changing so quickly around us. So I think an exceptional staffing business will know their specialism, will never ever allow anyone or circumstances to dilute their specialism, and they will be patient. The business will work, of course it will. The markets will do what they do. We can't control that, but we can control our business. And I think the last thing to mention, this is not what makes an exceptional staffing business, but the last point is just an interesting observation in that the majority of the transactions we are working on right now are seeing international purchasers come into the UK to acquire niche, privately owned staffing businesses. So again, going back to the question of earlier, niche is very important. Contract driven in a niche is exceptional to the purchaser, not to all of us, I appreciate, but to a purchaser. A niche with a contractor base that creates sustainable business is attractive. That's all I wanted to share with you. I appreciate that was probably very fast, and I get very excited when I present, so apologies. But I'd like to give you the opportunity to ask any questions, really, otherwise I could.
Did you get involved in IPO?
We haven't in the last 2 years, but we can and do, but we haven't of late. So in the last 12 months, the only northern IPO has been, well, I guess it's actually not yet even disclosed, so let me not comment, but we have not advised on an IPO. I have not.
Effectively putting 2 businesses, a buyer and a seller, together.
In summary, correct, albeit clearly we are involved years before that. So again, that's a good question. Some corporate financiers, I see them as agencies, so they will introduce A and B, and they will let them do what they might do. We don't do that, so I work with my management team years before we will even consider approaching a purchaser.
Will you actually, do you get involved with kind of funds or predominantly angels?
All of the above. So we often see our clients being approached by private equity, venture capital, individuals. So right now, Project Strand is a transaction we're working on. We have someone acquiring 51% of the business. That individual was the founder of Prime Time, actually. He is offering to acquire a controlling stake in our business or our client's business. So the acquirer, purchaser, investor, is largely irrelevant, really, in that we can advise at any of those times. It all depends on objectives, doesn't it, as to why you would want to attract an investor versus a purchaser.
Cash.
Great, mind you.
Just for an investor's perspective, for international private equity funds, which sectors are they targeting within the recruitment industry?
Good question. We've had, in the last few weeks, given that large transaction I referred to, we've had a number of conversations with funds. IT is the most exciting sector for fund investors right now, closely followed by medical, and I would say third, oil, gas / engineering. So those are the three sectors where we are seeing substantial interest, albeit, I think that exceptional businesses can be in any sector. So some of my most exceptional clients, in my opinion, are blue collar, actually agencies. Some people would almost turn their nose up at that. Really, but actually, one of my best clients is I can say this because my clients are happy for me to refer to them. Taskmaster Resources was voted the best company to work for in 9, 10, 11 by the FT. Fantastic staffing business, and it is a blue collar, I guess. Mid-sector staffing business. They provide drivers and they provide industrial temporary staff to some SME businesses, but that business is genuinely exceptional for all of the reasons we discussed. But I think IT, telco, engineering, oil, gas and medical are exciting.
What about digital?
Digital, I would include that, in IT for me. That's probably me not being very, very good when it comes to technology, but IT, digital, telco, I see as the same, and yes, very interesting.
Will the kind of wider economic climate have much of an impact on what PE ratio you would guess?
Yes, that's a good question. Yes, it would. One thing that PLCs or listed businesses often say is that they would never pay for a business more than their current quoted price earnings multiple. So I think on a previous slide, we looked at some examples of multiples. I won't be specific, but I spoke to one of those chief execs Monday last, and he said specifically, Carl, this business is a good business, we'd love to acquire it, but we cannot pay for that business more than our current business is valued at, which of course the investors will see that as almost a foolish investment. So I think it really does depend on the acquirer. But you can see a range there, Matchtech trading at 11 times, so maybe that's their ceiling, whereas Savoca 5 times. But you know what, I think like anything in life, if you make sure the business is exceptional, the multiple will work itself out. Obviously we have to negotiate hard, and going back to what you said before, whilst putting A and B as part of the process, once you put A and B, you've then got 6 to 9 months of so much more. So negotiating the right multiple, the right deal structure, the right earn-out agreement, those things are so important, and are often important.
What's the average discount you put on a PE multiple on a recruitment business that's dealing with a lot of international clients?
But it's a privately owned SME.
Yeah.
20 to 40%, depending on how quality you perceive as the business and how exceptional it is. I keep using the word exceptional because I think that I want to take us back to the subject of the presentation. It depends on how good the business is and how attractive it is. As long as I am introduced to a business sooner than later, we can make sure the business is exceptional, or even perceived as exceptional. Maybe it means as a management team you see your business change, and maybe you aren't happy. Maybe you don't want to go out there and tell the world that you've just taken on a new leasehold in Farnborough, or maybe you don't want to tell the world that you've just recruited a new marketing manager. But if that helps you achieve the £1 billion valuation versus £200,000 one, then I think maybe I'd be an open-minded person.
Do you see any difference between that? Going back to the LLP versus limited company, is there any difference in your own mind in terms of disposal or acquisition?
The short answer is no. So if we were looking to acquire an LLP or a limited business, we would approach both in the same way. The only two things I would sort of say that contradict that are, if you have a limited company, so as a parent, and you have an LLP underneath the parent, whereby the LLP is owned partially by the limited company and a member, which is what we've just had in a recent case, that is an issue, because actually what you have is, you have someone having to acquire the limited parent and also having to acquire the LLP, 2 transactions. So that's an ineffective structure. So right now we are restructuring that business, and there will be one limited company which owns another limited company, a subsidiary, who will have a minority shareholder. That shareholder will give us a drag provision in a share purchase agreement or shareholders agreement to make sure when the parent is sold, that minority will sell with us. So no is the answer, but I think just be cautious. There's a complicated membership structure in the LLP.
What are the common factors for deals falling through when you begin the process?
Wow, that's a great question. If you've got an hour and a half, we can chat through. Most common things of late, right? I think inaccurate, unreliable forecasting data. So believe it or not, every single business I meet when I first meet them will say, Carl, the last 2 years have been hideous, awful, but the next 12 months are going to be awesome. Brilliant, yeah, good luck with that. So making sure that your forecast is deliverable is so important. And what I mean is, you can assume that once you agree heads of term with an acquirer, you can assume it's going to take 3 to 6 months from there to conclude a deal, bearing in mind there is legal, ops, and financial due diligence to take place. Each month, throughout that 6-month period, your purchaser will say, right, your forecast was delightful. Can we see your management for April, May, and September? If you don't show that you've delivered your forecast, first of all, your forecasts are ignored. You are doubted as an astute business person because you forecasted this substantial growth and it hasn't happened. Why? And all you do is chase your tail. Oh, we didn't win contract there. Oh, we lost the contract manager. So good, reliable, thought-through financial information is one of the key reasons why a deal yesterday fell over. And that's really frustrating for me because you assume your client knows their business and knows their forecast and knows their pipeline. Often not, I'm afraid. So that's the one reason. Secondly, legal due diligence. So again, as a corporate financier, I'm not a lawyer, so I can't possibly spend months making sure my client is legally compliant. But as soon as the purchaser comes in, we'll get a big legal due diligence questionnaire. First question, can we see contracts of employment for all of your staff? I asked the question of my client 3 months ago. You obviously have contracts of employment, don't you? Yes, of course. We request contracts of employment. Oh, we've lost them for Mary and John. Well, that's great, isn't it? Thank you. And before you know it, actually, a lot of the things that you might not see as important are really important. And it leaves me as an advisor in a really tough place because I'm almost reacting. So one thing we've done now, we've readdressed how we approach our advice, is we demand that before we are engaged to advise on a transaction, we carry out a full strategic review of a business. So we said, right, let's look at your business now, let's understand what you want to achieve, let's make sure it's achievable given what the market is delivering for us, and what do you need to do between now and the point in time when you want to create an event to make sure your business is exceptional. And it will deal with things like going through almost a legal due diligence process, a financial due diligence process. And again, Stuart and I have got mutual clients who have come through that process. And I think it is extremely beneficial. But I think legal and financial due diligence are where people fall down, specifically financial information. Without question.
Carl, that's absolutely fantastic. I am going to cut you off in your prime to a degree.
Please do.
Time-wise, we're overrunning by about 20 minutes, but we have got a 15-minute Q&A scheduled for the very end of the day, which actually the way that this is working today and the sessions with the speakers so far, I suspect will probably still come in roughly on time. But thank you very much indeed, Carl. That was